Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Global rate bets shift beyond the Fed. Traders price faster hikes from Tokyo to London, raising the risk that bonds could amplify portfolio losses. President Trump orders a substantial reduction in U.S. South Korea military drills. He cites his relationship with Kim Jong-un and hints at Iran war frustrations. India pulls in more than $50 billion from overseas citizens, prompting the RBI to close a special forex deposit window early. Sri Lanka, meanwhile, pushes capital markets to fund growth. Its top regulator joins us to discuss expanding equity and debt market financing. And Singapore's stocks outperform global peers as strong tech exports tame inflation and rising earnings fuel a Goldilocks rally with room to run. All right, let's take a look at Asian markets. Asian markets are taking their cue from a weaker US dollar after soft retail sales data reduced bets on a September Fed hike. Brent crude edging higher after Israel attacked Lebanon in the deadliest day of strikes since both sides agreed to a ceasefire. Meantime, traders are pricing in faster rate hikes in major global markets other than the US, threatening traditional bond portfolios. Higher energy costs and the AI boom are fueling inflation pressures, with South Korean debt falling nearly 9% this year. For more on this global tightening wave beyond the Fed, let's bring Ruth Carson, our Chief Asia FX and Rates correspondent. And Ruth, it does seem like we've been concentrated too much on the Fed. Other central banks are moving more aggressively, it seems.
Absolutely. It's not just a Fed problem. The world has a world problem. You know, if we look at what swaps traders are telling us, warning us, you know, South Korea, we've got Japan, we have got the UK, Canada, all these markets are major bond markets, and tightening bets are rampant in a lot of these markets. South Korea alone is about 100 basis points over the coming year, and that does spell trouble for bonds. They are meant to be the ballast in portfolio, giving you income. Now, higher yields will give you income, but it also give you capital losses if you get in at the wrong time.
So what does it mean? Are investors positioning the wrong way? Are they, I don't know, anticipating this?
Yes, and in fact, we're talking about a 60-40 portfolio construction, for instance, and people are increasingly questioning it, especially in this part of the cycle. No one is saying that bonds, you know, will be shunned forever. No, but there are always cycles to everything, and one has to also ponder. When I speak with investors, you know, real money all the way through to some of the fast money funds out there, a lot of them are saying that bonds are just no longer the ballast that they were. So should you be 80-20? Should you be 90-10? It's up for debate, but definitely we are in a rate hiking cycle, at least according to swaps markets.
You're going to wonder where safety lies now that the bond market isn't it. And talk to us about South Korea in particular. I mean, we're talking about, a 400 basis point hikes pretty much across 7 major markets, but the most would come from South Korea.
100 basis points alone in South Korea. And that does send a very strong signal here. Growth is good, inflation is good. Why would you hold bonds in that environment? Now, also remember that South Korea is a bit of a bellwether as well for the Asian markets as a whole. I mean, it's got its own dynamics when it comes to the stock side, you know, with a big AI boom. But again, when you take that macro view, it does kind of tell you a 9% loss on the year in local currency terms. Why do you hold bonds in this environment?
It's not just the AI story, it's also the oil story, and this prolonged Iran war is not helping.
No, and again, this is not a story that's just unique to South Korea, but Asia as a whole is a big net importer of energy. And where does a lot of the energy flow through? The Strait of Hormuz, where we know that it comes from the Middle East. And that's why we're seeing this problem in Japan as well, where inflation is high, and importer inflation from energy costs is weighing on the bond market. Yes, we can talk about rate differentials and, the carry trade and demand to sell the yen. But a lot of it comes down to simple prices, and there are price pressures from an ongoing war.
Bloomberg Chief Asia FX and Rates correspondent Ruth Carson is sticking around. Let's get market insights with Christy Tan, Global Investment Strategist at Franklin Templeton Institute. Christy, good to have you with us. I mean, how do you position now that bond is not the safe bet?
Really glad to be invited back, Haslinda. And to Ruth's point is that, whether or not it's a ballast, I think it has to do with there's just too many opportunities, too many alternatives that investors can look at. So the bond markets at this point in time tend to be a little bit underloved. Now, and we are looking at higher yields at a time when the economies are not going through recession risks. They are not even going through like hyperinflation. So I think there are a lot of concerns in the yields, in the expected inflationary expectations that are a little bit looking elevated right now. So beyond all this, I do still think that there's certain values in, perhaps U.S. Treasury yields even. At this point in time.
Where on the curve?
Oh, that's a great question. So we were initially thinking stay short duration because, the term premium could head higher and higher. The deficit situation is not improving in the U.S. But, however, the recent rise in the long-term yields, and we saw recently in the 10-year, 30-year auction this week, there's a 20-year auctions. The recent rise in yields suggests that there's greater compensation now in the longer end. Of course, don't go the ultra-long. But we do think that, if you're ultra-conservative, just stay in the 2-year. It's fine because break-even shows that it needs to rise above 9% for bond investors in the 2-year space to lose money. And we are at 4-ish. So I think, 2-year, 5-year, even up to 10-year, I think those are really great areas to get into right now.
So that's treasuries. How about the bond markets here in Asia? We talk about how, Korea will be impacted, Japan will be impacted. What do you do with these markets?
Yes, so it brings down to the preference, whether your 60-40 will prevail, 80-20. And at this point, I think the Asia bond market space does not come as appealing as even emerging markets, LATAM, for example. So they offer greater, I think, returns and income from that perspective, from the yield level per se. So I think relatively speaking, and everything is relative when it comes to investments, returns, Asia fixed income appears to will stay in an unloved situation.
And I might just jump in there, Christy, with a question of mine, because Japan is very much in focus. And we've got a JGB auction coming up this week as well on the 20-year part of the curve. How do you see JGBs in a portfolio right now? Do you not touch it?
Only for the brave, Ruth.
Only for the brave. And also, if you have a view that the yen is not going to weaken further or it is going to actually appreciate significantly. And I think we are not there yet. And, another 25, 50 basis point hike in the JGB yields are probably going to draw some institutional interests back into the market and domestic interests perhaps because they are not subjected to the yen's or they're not exposed to the yen's vulnerability. So I think the yen plays a big part here, which will drive, the appetite for JGBs, and at this point, I think it is very limited.
You talked about how we're not there yet, pointing to the yen. Expectations are that the BOJ will raise hikes. I think 70% expectations of the rate hike coming in September. That's not good enough, right? I mean, one and done at this point is not going to do anything for the yen.
It's priced in, and I think everyone expects the BOJ to do more in order, and that's why expectations are at this point in time will not be very effective in sheltering or cushioning the yen from weakening further from here.
And Ruth, what are you hearing from the traders about the yen?
So we have a fantastic option on the terminal called FXFM Go, and it shows you options traders' thoughts, essentially, a bit of a crystal ball. And when you look at what option pricing is telling us, 170 is possible. 180, this time next year is certainly possible. So despite the threat of intervention and despite the historic joint intervention that we saw, rate differentials still matter. The Japanese themselves, we had data last week from the MOF showing that they bought a combined 4 trillion yen worth of global stocks and bonds immediately after the intervention. So they were banking on a stronger yen to put money offshore. The carry trade is alive and well. And if that's the case, we will see continued yen weakness, I would say.
180 for the yen? I mean,
it's a small chance.
I think that's a little bit extreme. A lot has to happen for that. And we're talking about like economic shocks. We're talking about, additional geopolitical shocks, which I don't think it is the base case at this point in time. In fact, our base case is probably looking at de-escalation in the geopolitical arena.
We're not seeing that yet, though. Every time you think there's a resolution, there isn't.
Well, it is very conditional. And I think when de-escalation by us, I think it means that we are looking at partial reopening of the Strait of Hormuz. And why are we not as worried at, say, the start of the war? We don't think that the Strait of Hormuz will go back to pre-war levels in terms of the, its participation in the global energy complex. We do think that a partial reopening, and at this point in time, 5 million barrels per day gets through, and there is a reduced, and this is going to be structural, reduced dependence on the Strait of Hormuz as a logistical basically supply for energy. And that in itself will mean that that geopolitical advantage that the Strait of Hormuz was holding on is going to reduce quite visibly.
And I might just jump in there, Christy, with another question. So what does this mean for demand for the dollar?
Great question. So we do think that I think, the dollar at this point, we have a view that the dollar is probably going to trade quite flat into the end of the year. A few things. So the dollar does have a cyclical support, but it has a structural ceiling. Why do I say that? I mean, if you look at it from a short-term perspective, the yield carry in the dollar is still pretty attractive. I mean, you have treasuries at 4-ish%, which we did not see, last year. And so the dollar does have some kind of a cyclical support. But in the medium to long term, we are looking at a twin deficit story. We are looking at, that structural term premium that will be embedded and that geopolitical volatility. We're saying that geopolitical may ease, but it will still stick around to at least exert some volatility in the currency markets from time to time. And that, I think, is the key driver that could put a structural ceiling to the dollar.
How do you play the AFIC space today? The dollar is weaker. The yen not benefiting, but EM currencies are. Do you keep believing in EMs from here?
I think we have to see EM not as a block, but let's put it in, say, who are the energy importers? Because they will be more vulnerable.
So stay away from the Indian rupee, Indonesian rupiah?
Well, to a certain extent, yes. And we have seen that manifesting in the currency weakness. But the exporters and the beneficiaries from the AI trade, and I think whoever owns the bottlenecks, those currencies will probably play better.
All right, Christy, hang tight. Our thanks to Ruth Carson, our Chief Asia FX and Rates Correspondent. Christy Tan of Franklin Templeton Institute is sticking around. Up next, President Trump orders a cutback in U.S. military drills with South Korea. We'll discuss what could be behind the unusual public jet at a longtime ally. Keep it here with us. This is... Welcome back. You're watching Insight. We're keeping an eye on energy markets after Lebanon suffered its deadliest day of Israeli attacks in months. The escalation puts pressure on stalled U.S.-Iran negotiations while Washington prepares fresh sanctions against Tehran. Meanwhile, Trump also took a jab at South Korea, saying he's reducing U.S. military exercises with a longtime ally, citing his good relations with Kim Jong-un as a reason. Our news desk managing editor Jill Deeses joins us now. And Jill, fresh fighting in Lebanon, attacks on vessels in the Strait of Hormuz, and U.S. plans to economically isolate Iran further. All that clouding chances of any deal to end the Iran war?
Yeah, it's really not looking good at this point, Haas. I mean, I think, look, you'd also have to take into consideration the fact that today, Monday, is supposed to be kind of the end of that 60-day ceasefire that the U.S. and Iran originally talked about back in June, during which time they were supposed to be, planning out various levels of peace negotiations, looking for something a little bit longer lasting. Obviously, that hasn't happened at all in the last 2 months. We really haven't seen any meaningful progress that's actually put us in a position where it does seem like there's some kind of, some kind of a lasting truce here. And instead, obviously, as you mentioned, you've got some of this fresh infighting, proxy battles taking place in Lebanon. And then you also have the United States saying here that, they're looking for ways to put even more economic pressure on Iran. Of course, what that means is a bit unclear. There's only so many more types of sanctions that you can really implement here. Maybe you're looking at secondary sanctions on other nations, which seems like it would be a really hard sell, particularly when the United States has its own domestic economy and the impacts that this war is having there to consider.
Meantime, Jill, Trump seems pretty unhappy with South Korea pulling back on military drills and sending a message perhaps to its longtime ally.
Yeah, this was a really interesting social media post that Trump had. He cited his relationship with Kim Jong-un of North Korea. He cited the costly measures, these military drills that were scheduled to take place today. They're actually still going forward. But this is kind of a very abrupt message from Trump here. Another thing that he kind of suggests in that post a little bit is this idea that maybe it's unrelated, maybe it's related, that, as we've been talking about, this concept of South Korea maybe not being necessarily as participatory in Trump's war with Iran as he would like. That same thing can kind of be said of many allies of the United States. But this does seem to be, again, another source of frustration that Trump has with his allies as he tries to bring an end to this war. So we'll have to see some of the ongoing impacts from the pulling back of these military drills. Again, still a little bit unclear as to how exactly that's going to play out here when they are still scheduled to begin. But again, just kind of puts another spin on this idea that the U.S. president is obviously very frustrated with the progress with the war.
He's not alone. Jill, thank you. Bloomberg's News Desk Managing Editor Jill Deese is there. Well, Christy Tan, Global Investment Strategist at Franklin Templeton Institute, is still with us. She believes a partial reopening of the Strait of Hormuz could bring Brent back towards $65 to $80 a barrel. Well, that's not quite happening, right, Christy? I mean, even if traders were to look past the headlines that's been driving the markets, the fact that oil remains above $80 a barrel, that is a concern.
Yes, absolutely. I think at this point in time, there's still, that conditionality of either U.S.-Iran talks or any kind of an agreement or any cessation of, the conflict. It seems to be very conditional. I think markets putting that into that oil price at 85, 90 type of level. However, I think, we are looking at the midterm elections approaching, and we're looking at a lot of the headlines and Trump's comments recently is posturing, right? So the audience is really the American citizens. And we have also a U.S.-China or Trump-Xi summit coming in September. So along those lines, we believe that the de-escalation is a more likely scenario. And that probably by mid-September, that could actually bring a partial agreement into fruition and bring about the lower oil prices. And by 2028 to 2030, I'm not saying immediately, but in the next 1 to 2 years, we're looking at a structural reduction in dependence on the Strait of Hormuz as an main energy supplier. We're looking at alternative pipelines, electrifications, and those will bring oil prices to a more stable and lower level.
The thing is, until that happens, it's still inflationary. Add to that the AI capex that's being raised, including, I think, if I'm not wrong, today Alphabet talking about raising funds in Australia because it needs more money. So against this inflationary pressure from AI in particular, how do you play AI?
Well, that's an interesting question. So we're really looking beyond geopolitics, and the inflationary pressure also suggests that the trade is no longer just in the hyperscalers or the Max 7. In fact, the MAX 7 has done, well, quite lackluster in the first half of this year. So we're looking beyond that. We're looking at again, diversification and how to build a portfolio that is resilient and not subjected to the vulnerability of, say, energy, for example, energy demand, or the availability of computing. In fact, now computing is the scarce demand over languages. So own the bottleneck and own the companies that are
so
actually...
that's infrastructure.
Infrastructure, great. And perhaps, even we're talking about, like in the China AI space, is more the physical AI and not so much about, where it's less investable in the large language models.
The thing is, China AI used to be the alternative that people gravitate to. But even then, now people are questioning about the ROI.
Valuations are looking really hefty relative to the US, and I think that is also a function of there's a lack of investable companies within China AI space. However, I think that's going to change, and we do think that the IPO pipelines coming out, we saw CXMT's performance, and we do think that IPO pipelines and perhaps alternative fundraising opportunities within China AI could come into flow.
So what would be your conviction calls for the rest of 2026 and into 2027?
So, interestingly, it has very little to do with geopolitical concerns. I would still overweight Japanese equities. I think, looking beyond the weak yen, the reforms that are happening, the BOJ monetary policy normalization that is also ongoing, that, will actually draw, I think, attractiveness of banks and financial sectors within the Japanese equities markets. And at the same time, I think we still need to own the AI space, but be very, very selective and identify the bottlenecks. And it may not be within the US, it could be still, up in emerging Asia. And the third is actually, I think, we prefer to own actually China A shares. And looking at how the monetization of AI, I think that's what investors demand, because investors are going to punish those who disappoint in terms of CAPEX. I would look at CAPEF, which is capital efficiency, instead of just pure CAPEX play.
Just very briefly, Singapore has been an outperforming global peers.
Yes.
That's pretty unexpected. Would you be pumping money into the Singapore market?
Oh, absolutely. I think it is something that the authorities have been supporting, and is definitely a policy-driven. And we're looking at, in fact, this is where the beneficiary of the geopolitical issues in the Middle East is benefiting actually Singapore equities markets and companies and earnings.
So there's plenty more upside for the Sing market, despite the gains that we've seen so far.
Yes.
All right, Christy, we'll leave it there. Christy Tan, Global Investment Strategist at Franklin Templeton Institute. Coming up, Sri Lanka's markets are at a turning point. The top regulator, SEC Chairman Hareendra Dissabandara, will be joining us next to talk regulation, investor confidence, and what's next for the country's capital markets. Welcome back. You're watching Insight. India has drawn more than $50 billion from its overseas citizens since June, prompting the central bank to close a special window for attracting foreign currency deposits a month ahead of schedule. Let's go to Mumbai and Anirban Nag. He leads our money and power team in India. Anirban, is the RBI's decision to stop the special deposit window a surprise?
A complete surprise, Has. Just a few weeks ago, the RBI Central Bank chief told reporters that they didn't have any intention of closing this deposit window. And then suddenly, out of the blue, on Friday evening, late in the evening, they sent a statement across saying that they're closing this special window on August 31. Now, market men have been taken by complete surprise by this, simply because obviously there are costs involved, and the RBI will be taking most of the the hedging costs from the bank. This was a very attractive route for the diaspora to put in the money. Money was coming in loads. We saw 50 billion coming in by August 13. That will probably swell to about 70 billion by the time it finishes. Now, obviously, the surprise part of it is the costs would have actually come into play here. 70 billion is almost 10% of India's reserves, which is around 700 billion. Now, there are costs of maintaining those reserves, especially in a scenario where global interest rates are probably headed up. That is the kind of money that the RBI will probably have to set aside to maintain these costs. Now, that's not going to be a simple sum of money. Also, the other thing that to keep in mind is in the past few weeks, criticism about this FCNRB or the special deposit scheme has grown. An ex-central banker told Bloomberg News that this is not the kind of money India needs. What India needs is long-term capital, foreign capital, and for that structural reforms have to be carried out. That's the kind of money India needs, not these short-term debt flows.
So having said that, Anirban, what will be the impact for markets, for the economy?
Yeah, that's a very good question. So what we are seeing is that because of these FX flows, a lot of the swaps that are happening when the dollars are getting converted into rupees is helping the Indian banking system, especially at the shorter end of the curve. What we've seen is that the 5-year notes have dropped about 47 basis points compared to just 25 basis points on the 10-year. Now, what that has done is that the cost of not just the government, but also for the corporate borrowers has fallen. Now, that's a very good sign that has happened. But what this does now is that the short end of the curve will bounce back. That's the yields will go up because of this sudden decision by the central bank. As a result, liquidity will tighten a little bit, but we'll see how that plays out for the broader economy.
Anirban, thank you so much for that. Anirban Nag, he leads our India Money and Power coverage. Meanwhile, Sri Lanka's inflation fight may be entering a new phase. After aggressive rate hikes and months of price pressure, its central bank sees light at the end of the tunnel. Governor Nandalal Weerasinghe told us inflation is on track to return toward the bank's 5% goal, but much depends on where oil prices go from here.
Our baseline scenario is that if oil prices remaining around $80 a barrel towards this year and next, then we can manage the situation. If it remains at level, I think we can manage inflation. We are expecting inflation to come down around our target level of 5% in, say, towards the end of this year and early next year.
And Sri Lanka was one of the big winners of 2025 as the economy bounced out of an economic crisis. Yet gains have stalled as the energy crisis sparked by the Iran war raises inflation concerns. Particularly impacted is the hotel sector. For more on his home market, let's bring in Bloomberg Markets reporter Anthony Stevens. And Anthony, what's really stalling the gains in the Sri Lankan stock market?
Yeah, we should have had this conversation last year. It was such a good year for Sri Lanka last year, bouncing out of the crisis. But now on the way back from the Iran crisis, it's lagging the MSCI frontier market really quite badly. And that speaks to a lack of energy diversification in the economy vis-a-vis other economies like Pakistan or Vietnam in the frontier bucket. There are also much larger economies that are benefiting from the China plus angle on light manufacturing. So Sri Lanka is more geared towards tourism, and that is much more leveraged to oil prices from both the domestic front and the aviation front for incoming tourists. And you're seeing that part of the stock market lag materially. Alongside that, a lot of domestic demand plays are also struggling as the local population struggles to find fuel and energy at reasonable prices. So that stalled out the market quite meaningfully here. And there's also a lack of new listings in the exciting sectors in the economy. So there was one listing, Wealth Trust, on the financial side that went so crazy that the market had to be halted for a little while. And there's been some reforms around new listings, but there's not a lot of new listings coming into the market. And that is what's going to be important going forward.
And it's supposed to be a big year for IPOs for Sri Lanka. In terms of catalysts, Anthony, what are investors looking out for next?
Yeah, so in terms of catalyst, there's the push and the pull factor, right? So as the central bank has said, oil prices remain extremely important, right? If oil prices move on materially from $80 to kind of the $100, there's not very much Sri Lanka can do domestically to alleviate that. On the pull side, there needs to be more listings around the exciting front of the markets. So, for example, real estate is a very strong sector. So, for example, REITs, where legislation was passed earlier, might be an interesting place for new listings to come through, and there's a lot of consultation around that. The tech sector, actually, Sri Lanka's nascent tech sector is doing quite well, with SoftLogic, for example, being one of the names that is rallying. So any enticement of incremental tech listings on the market could also be interesting. But in a broader sense of the word, the Western world needs to recover from the higher energy prices and start traveling again. Tourism does need to recover for the market to have any meaningful push. Also, agricultural markets globally have to deal with climate change, and how that plays out in the back end of the year in terms of the harvest around tea and other agricultural commodities will be an important factor for rural consumption. So not a lot under the direct control of the country, being a small open economy, but there are some things in terms of the corporate reform and the capital markets reform that the country needs to continue to push into to consolidate the recent gains.
So still lots to do. Bloomberg Markets reporter Anthony Stevens there. Thank you so much for that. Our next guest is the chairman of the Securities and Exchange Commission of Sri Lanka, DBPH. Dissabandara is part of a Sri Lankan delegation and visiting Australia this week to attract investors. He joins us now. Professor Dissabandara, thank you so much for joining us. First off, what is the message you're bringing to Australian investors?
This time, in our, according to our capital market plan, so we thought of inviting foreign investors to come in, and at the same time inviting our own Sri Lankan investors to come in and, get the benefit of the Sri Lankan opportunity. So we wanted to showcase our country, our potential in the Sri Lankan market. So that is, mainly to, share the information with them and to give them a chance to come and visit Sri Lanka for investments.
Well, the country has a good track record. Growth is about 5%. You had record FDI last year. But investors are really concerned about policy instability, even the regulatory environment. How do you allay those concerns for investors?
So, I think policy consistency in Sri Lanka is better than earlier now with the new government policy and all. So they did not change major policies. They keep on track, especially the financial policy and the fiscal policies are on track with the IMF plans. So and that's why IMF said Sri Lanka is a case study. So I think we are in a position to attract more foreign investors, institutional investors, because of our policy consistency together with national economic stability and the political stability.
But in terms of regulatory bottlenecks, what might you remove this year that investors can look forward to?
In the capital market, we have formulated a capital market development plan with 12 key areas. So in our domain, basically, I don't think we are not over-regulating, but then there's nothing to remove. But at the same time, so we would like to encourage investors. So we are in the middle of the discussions to reduce the transaction cost in Sri Lanka, and at the same time, there will be a lot of market development initiatives together with regulation. And there were some governance-related issues earlier. So in this commission, we have taken out 70-year barrier for the independent directors and all. So I think with that, at the moment, we are having appropriate regulation in the market.
Professor Dissabandara, the Iran war has impacted a lot of markets. It sent oil prices above 30-40% pre-war levels. I'm just wondering what those prices might mean for the Sri Lankan market going forward.
So you are referring to oil prices?
Yes, oil prices.
Yeah, in Sri Lanka, there are very few listed companies directly related with oil prices. Even though we are impacted by the crisis in the Middle East, however, it is not severe. So only few companies are. Can be affected, but however, it won't be a big impact on the market as a whole.
So the Sri Lankan market, you're saying, is not vulnerable to prolonged energy shocks?
Yeah, I think even governor has mentioned that oil prices will be, in Sri Lanka it won't be a big issue because it will be stabilized. But some of the companies like oil-related, oil-based companies can be affected negatively. However, in the long run, if you take the market as a whole, it won't be a big issue. That is my belief.
Professor, I'm just wondering your assessment on foreign investor stance in the Sri Lankan market. We've had the IMF talking about potential capital outflows from emerging markets as a result of what's happening in Iran. How are you assessing that risk?
It is a concern. It is a concern. However, I think. At the same time, people are going, investments are going out. So, but that is why we are here, and we were in some other countries, and we will be in some other markets to promote Sri Lanka and to attract some other, funds and the investors towards Sri Lanka.
So, might you be considering some safeguards for investors?
Now, basically, if the investors coming through the IIE account, and they are very much safe because the system is there. And at the same time, at the SEC level, we are having appropriate regulation to cover up situations for any kind of covering local or foreign. So I think our act and the provisions are in par with global standards, and Sri Lankan Act is basically more or less similar to Malaysian Act. So what Malaysia offers and what Malaysia regulates, we too in Sri Lanka, we can do the same thing.
Professor Dissabandara, I want to take a look at the IPO market in Sri Lanka. 2026 was supposed to be a breakout year for IPOs in the country. Realistically, how many are in the pipeline?
Now, compared to earlier, I think this year there will be few, but as far as I know, there are about around 20 companies are getting ready for IPOs. Among them, there are some big companies as well as medium, and there are several, 6-7 small companies. They are getting ready for the battle.
Are we looking at perhaps 10, 12 IPOs this year? Which sectors will be leading the IPOs?
Now, basically, I can't give you the names of the IPOs, but I know they are getting ready and they are dealing with the investment managers. So there are about, I'm sure, within this week, this year, there will be at least 6-7 IPOs, and in time to come, within 1 year's time, there will be at least 12-15 companies will be listed.
Recent IPOs like Cable Solutions have done well. In fact, Cable Solutions doubled. Are there concerns about the quality of those IPOs, that they're attractive, not speculative, when it comes to the listings in the country?
I don't think they are speculative. basically we were depressed for some time because of the crisis situation. So there's a increased interest among the investors. So if you look at some of the 3-4 IPOs we had earlier, so they were oversubscribed and a huge demand. So I don't think it's a manipulative attempt. If so, we could have observed and taken action. So in time to come, I think I think in time to come, maybe in 6 months or 10 months time, we will be able to see at least one SOE listed on the exchange. Because government is seriously working on the matter, and the relevant regulation is with the rule formulation. That means the Aegis Department and relevant authorities. So I hope government will be able to list at least few companies very soon. So with that,
right.
Liquidity.
And Professor, we know that the SEC's roadmap emphasizes SOE IPOs. Where are you with that, and which ones are closest to listing?
Now, as I told you, the regulation, the act will be passed very soon, and the model we are going to have is very much similar to Singapore. So there will be, maybe rather than listing each and every, individual company, it will be a holding company. So according to the information, the holding company will be listed on the exchange.
Professor, thank you so much for your time today. DBPH Dissabandara, Chairman, Securities and Exchange Commission of Sri Lanka. India's just been trading for about a minute now. Let's do a check on where they stand at this point in time. We have the Sensex and the other benchmarks in negative territory. Of course, we're keeping a watch on tech and chip-related stocks. PM Modi says India will have up to 8 more chip plants in the next 7 to 8 years. It's already pledged $20 billion to advance chips as well as smartphones. We have the Nifty 100 currently down by 0.2%. In terms of the INR, the Indian rupee trading at 95.55 right now. It is down by 0.1% versus the USD. And still ahead, Singapore stocks are hitting record highs and outperforming markets around the world. We'll discuss what's behind the surge and whether the momentum can last. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Singapore stocks have outperformed the world over the past month. Their traditional strengths of high dividend yields and resilient balance sheets have had a lift from what JP Morgan describes as a Goldilocks economic backdrop. For more, let's bring in our Asia equities reporter Bernadette To. And Ban, this is unheard of. We're boring, we're stable, but now we're partying.
Yes, we are. Singapore's had a really good year. It's been having a really good time. It's been really resilient amongst the global volatility in the market. So it's been a fan favorite amongst a lot of investors.
A lot has to do with what you talked about, stability in the different factors, including the Sing dollar as well, right?
Yes, so there are lots of positives going on for Singapore stocks. One is the high dividend yields, which we have mentioned, and also the strong Singapore dollar, which is definitely really appealing to investors. But what's also new this time around for Singapore stocks is that there is also capital appreciation. There is a growth story that's led by moderated inflation and also just good corporate earnings because of the tech exports. So that with the dividend play and the growth story is just making Singapore stocks really, really attractive.
You talked about good corporate earnings. We're seeing that a lot for the banks in particular. Not surprising, they're leading the pack up. The question really is whether there's more gains to be had. If you take a look at DBS, already at 75 to 80 bucks right now per piece, and people are looking at perhaps even $100 for the stock. So you've got to question whether it's stretch valuations or whether there's more upside from here?
Valuations are definitely higher than they have been historically, but at the same time, there's a lot going on for Singapore banks. It's part of this booming wealth management industry in Singapore, and that's what's driving the Singapore banking stocks to rally really hard.
So apart from the banks, anything else that's doing well?
There is a lot of concentration in the Singapore banks, and that's something that's a concern for investors. But at the same time, there is a broadening out into the other sectors, and we see a lot of government measures to try and boost the stock market overall, so that it's not just the traditional banking sector that's there to benefit, but hopefully, the other sectors will also do well in this whole record run.
And of course, we heard from Goldman talking about this Goldilocks economic macro environment, but this is a country that's reliant on trade, and with the ongoing Iran war that's pretty prolonged right now, are there risks right there where, which has been cited as the Goldilocks situation?
I think JP Morgan said that, Singapore is at the Goldilocks phase. It's not too exciting where, it's have a lot of volatility with the AI trade. It's also resilient against the global volatility because of the Middle East conflict. But at the same time, it's resilient because it doesn't have that kind of sharp swing that we can see in North Asia markets with the AI exposure. So right now with Singapore, it's just nice. It's Goldilocks.
Just nice, and it's stable. Bern, thank you. Asia equities reporter Bernadette Toh for us there. And here are some of the stories we are following. Anthropic is telling prospective investors its second quarter revenue jumped at least 14-fold versus the same period a year ago. Documents seen by Bloomberg News show the Claude chatbot maker reported preliminary revenue of more than $11.5 billion compared to $787 million in the corresponding period in 2025. It comes as Anthropic battles rival OpenAI to win over corporate customers ahead of the potential IPOs. And Alibaba says its AI models have accumulated more than 3 billion global downloads in the last 6 months, surpassing Meta and Google to become the world's #1 AI model. A company statement says Qwen has open sourced more than 460 models, and its ecosystem has spawned over 300,000 derivatives. A Hugging Face report says Alibaba's AI models now have one of the largest foundations of the open weight AI ecosystem. And before we go, here's a look at tomorrow's show. We speak first to BHP CEO Brandon Craig about the company's financial results and recent worker strikes at its iron ore export hub. And former Northern Ireland Assembly member Conal McDevitt will be joining us to talk geopolitical risks and the UK's outlook under a new Prime Minister. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.